Hi guys, Ian Johnson from driversuccess.com. Today we're going to talk about asset-based financing options. And what we're going to do today is we're going to cover basically 3 essential tools you can use to lower your cost of capital and improve your cash position. And that is to use factoring, purchase order financing, and inventory financing. And before we get started, I just wanted to say one of the reasons why asset-based financing has become so popular recently is because we've got a very low cost of capital, very low interest rates to borrow money for companies, okay? The issue is that that is being offset by the fact that customers are taking longer to place orders and they're taking even longer to make their bill payments in terms of paying off their invoices. So when you got an economy where your sales cycle times are longer and customers aren't buying as frequently, well, you're going to have to finance inventory longer, okay? And if you've got a situation where customers are taking too long to pay or going delinquent or closing, well, then you're going to have to finance your receivables for longer durations and it's going to cost you more, okay? So right now, it doesn't matter how low interest rates are. The problem is how fast you can sell inventory and how quickly you can collect from your customers. And this is why these options are becoming popular, okay? The first one we're going to cover is called recourse factoring. Now, recourse factoring is one of 2 factoring options, okay? Recourse factoring allows you to sell a customer's unpaid invoice to a financing company. So you have to do this early in the process. But essentially what happens is you're going to sell that invoice to a financing company and they're going to basically advance you 90% of the invoice's value, okay? So let's say you had an invoice of $1,000, okay? The financing company will advance you $900. They'll proceed to collect directly from your customer, and once that $1,000 invoice is paid in full, they'll reimburse you the $100 difference, and then they'll deduct their fee, okay? You'll have to determine what that fee is. But it's important to remember that with recourse factoring, you assume liability, okay? You are assuming and actually guaranteeing that your customer is going to pay that final invoice. So it's good to use this strategy when you know you've got a customer who pays well, okay? The second one is called non-recourse factoring, okay? And simply put, non-recourse factoring is different from recourse factoring in the sense that you don't assume any liability. So in this case, it's a positive because there's no liability on your part in terms of final customer payment, okay? And what you're doing here is you're not going to get 90%, perhaps you're only going to get 80%, okay? So you're going to have a lower upfront advance, again, with a $1,000 invoice. You're going to get $800 up front. Okay, and then the company's going to go collect directly from your customer, the financing company. They're going to reimburse you the $200 difference, and they're going to minus their fee. Okay. Now, in terms of recourse factoring, typically because you're assuming the liability on the final invoice payment, your fee is going to be lower. Okay. In terms of non-recourse factoring, because you're not assuming as much liability, you're basically going to pay a higher fee. Okay. So with recourse factoring, you're going to get a higher upfront payment. You have to assume the liability for the final payment, and your fee is going to tend to be lower. Okay, with non-recourse factoring, you're basically going to have lower payment, higher fee, and you don't have to assume any liability. Now, factoring's been around for thousands of years, and it's very popular, and companies are using it. But you really have to decide whether this is an option you want, especially in a situation where you've got plenty of open invoices or plenty of customers that are placing orders, but you're not able to collect soon enough. So factoring is an option, okay? So this is the first one. The second one is what's called purchase order financing, okay? And much like factoring, it allows you to use liquidity within existing purchase orders and confirm backlogs to finance your business. So purchase order financing, all right? Now, without going into too much detail, the simple strategy with purchase order financing is the moment you get a purchase order from a customer, you're able to use that purchase order as equity, okay? So it's a lot like recourse factoring or non-recourse factoring in the sense that you've got a purchase order for $1,000, the company's going to advance you $900 in order to do what you need to do in buying raw materials and finished goods to complete your customer's order, and it's going to go through this entire same process. So once it's invoiced, the financing company is going to proceed to collect on your customer's invoice, okay? So purchase order financing, it works in the sense that it allows you to use confirmed backlog and existing customer orders in order to finance your day-to-day operations. Now, the third one is something that's called inventory financing. Now, I'm kind of reluctant to use inventory financing. Okay, I want to talk about it today because I want to give it to you as an option. But what it allows you to do is it allows you to use existing inventory as a source of credit, okay, and as a form of business collateral. The problem is that you can't have any issues with obsolescence and slow-moving inventory, okay? So a big no to obsolescence and slow-moving inventory, okay? If you've got issues with slow-moving inventory and obsolescence, you know, don't bother with inventory financing. The other issue is that the interest rates are fairly high, okay? Interest rates are very high, actually. The interest rates are high, and you've got issues of very tight restrictions on borrowing. The other issue with inventory financing is that you have to have a fast inventory turnover rate, okay? So you've got to have a high inventory turnover rate. Okay, you've got to have an inventory that quickly moves. So if you've got product in your warehouse that is of high value, that you sell frequently, but you just got a problem collecting on invoices, then inventory financing may be an option. It's just the problem with this is that you can't have any issues with obsolescence and slow-moving inventory. You can't have any issues with pilferage or damage and theft and these type of things. And the interest rates tend to be higher than factoring or purchase order financing. I tend to stay away from inventory financing because in my opinion, if you've got a fast-moving inventory and you're selling product quickly, then just use factoring or purchase order financing. So that's pretty much it, asset-based financing options. Factoring has been around for thousands of years. Purchase order financing allows you to use confirmed backlogs and existing purchase orders in order to use that as a source of equity to buy the raw materials and the spare parts you need to finish orders. And, you know, if you want to investigate inventory financing, take a look at it. I tend to stay away from it. I'm not terribly, I'm not terribly interested in it because to me, inventory is incredibly important. And the important thing to remember with factoring is that it acts like a loan, but it doesn't appear as one as on your balance sheet, okay? And with factoring, the decision to lend you money isn't based on your company's finances. It's based on your customers' finances and their ability to pay their invoices. Consistent payers are probably good sources for factoring, but you're going to have to take the time to sit down with your customer and explain that you're going to basically sell their invoice, you know, to what amounts to a third party that's going to collect on it. Okay, so take the time to investigate recourse factoring and non-recourse factoring, explain what you're doing with your customers, take a look at purchase order financing, and in terms of inventory financing, if you want to pursue that option, just understand that if you encounter a slow sales cycle, because high turnover rates are so important with this option, if you encounter a slow sales cycle and you're doing inventory financing and all of a sudden your sales drop, you're going to have to liquidate that inventory in order to cover your credit line, and it's not always the best option. So that's it. Asset-based financing, factoring, purchase order financing, and inventory financing. Make sure you look at what you're doing and you review all the options. Take care. Ian Johnson, driveyoursuccess.com. Bye-bye.